And this gentleman by the name of Jon Levin, who is a mentor of mine, who is a god in my industry, he had billion-dollar plaques hanging on his wall, billion-dollar producer with Countrywide. And he had an office on Main Street, right there on the, literally overlooking the pier, right? We had the top building, how much we made back then. We had this top building, and he walked into my small little shop that I was their in-house lender, and the broker said, there was literally, they had a line on the floor that said, no one passed this line, and that's not Jon Levin. So Jon just marched his way in, and he looked at me very nicely and said, this is amazing what you've accomplished, but I can either take it from you, or you can come work with me. And I don't know, 21 years old, I'm like, oh, good Lord. So I sat down with him, and he explained to me really what I needed to be doing and how this business works. And that was my first taste of working with a correspondent lender. I think that month, I made $100,000. I had a check for $100,000. And this was when it was an insane market, right? When basically all you had to do is breathe on a mirror, and you could get a loan. Well, we all know what happened to breathing on a mirror and getting a loan. So what happened to Countrywide? Unfortunately, they had $9.6 billion in pay option arms. And the pay option arm was, hey, I'll give you an interest rate of 1.75, you get a 740 FICO score, I don't care if you really have a job or not, we're gonna give you this house. And I'll tell you what, I never wrote that business. And I'm happy to say my soul is clear that I never did that. If I did do a pay option arm, it was for an investor who I knew could afford the home, that understood what a pay option arm was. Unfortunately, there were so many people that wanted those really big checks. They wanted those checks coming in every 90 days, because what they would do would churn the loans. And we know what happened, right? Countrywide went under. Those loans went from 1.75 to almost 6.5%. You had a contractor or a gardener that owned 2 trucks that we said was making $200,000 a year, and all of a sudden he has a $7,500 a month mortgage payment on $1 million property that's now upside down. So, unfortunate, but it allowed me to move in my industry because Countrywide was no longer, we had to go somewhere. Well, Countrywide was bought out by Bank of America. So then I got a taste of the federal side, which I really didn't like very much. But I got to learn about regulations much more, why someone really does have to be able to afford the mortgage, right? And what came into play after that was the Fannie Mae and Freddie Mac DU rules, that you had to have at least a 45% back-in ratio. What that meant is that you had the ability to repay your loan, kind of important, that you had enough income and you had enough reserves to repay your loan. And I understood now that this was a liability, but also how to make it into an asset. Because before that, guys, I was just doing loans. I was super excited. I thought I was doing the right thing. I thought I was helping people, and I was making a lot of money. So that was a taste of reality for me. But it woke me up to what this really is. So when I look at properties now for clients, I look at it as a liability to begin with. But then I go, okay, how can we turn this into an asset for you? How can we make sure that this is something that you can support with your family? That this is a legacy for you? A lot of people want to move that property on, or obviously they want to sell and buy another property. My goal is to help them build their wealth by giving them new mortgages, right? But doing it the right way. So we've seen a lot of changes in the last couple of years. Right now we are talking recession. I'm sorry, for me recession is a good thing because recession means lower inflation, which means much more lower interest rates. In fact, rates have dropped. I priced out a loan yesterday on a 20-year fixed conventional loan, or excuse me, a 30-year fixed conventional loan, 20% down, at 5.5%. I had 5 agents call me and go, how can you possibly do this? My lender's saying we're at 6.75. Well, I am both correspondent and I'm broker. So I have certain banks that if you are very, very cookie cutter, W-2'd, clean tax returns, good FICO scores, good reserve requirements, and you're putting 20% down, yesterday's rate was 5.5%. The market actually improved a little bit more today, so guess what? I'm getting back on the phone today and I have a conversation with that client. Maybe now they're at 5.375. So we are seeing rates come down. Historically, over 30 years, we're 5%, right? So the days of 2.875, 3%, I don't know if we'll ever get back to that again, but I think we're starting to see this adjustment. We're seeing this, what I call a correction in the market right now. One of the challenges that we have is that numbers are a little skewed right now because people have been living off of credit cards. And I just got those numbers yesterday, and I wish I had the chart, but I'm going to do the chart for you. So in 2021, we're about here. In 2020, end of 2021, we're about here. End of 2022, we are up here. People are completely maxed out right now on the credit cards. And the credit card companies love them because they're just charging interest after interest after interest and increasing their cards. In fact, yesterday, I got a phone call voicemail from one of my credit cards. Congratulations, we just increased your credit limit. And I went, I don't want it. Right? But they automatically get that. So, the reason I'm talking about that, with the change in the market that we're having right now, if you know anybody that is living off of credit cards, we can get them out of that position. A lot of times their interest rate, their APRs on those cards are much higher than what their interest rate is now. But the challenge right now, even then, people don't want to touch that 3% or 3.5% on the first. And I don't blame them. But we are living in a very equitable world right now. Because of appreciation, because of values of homes, we have a ton of equity in our properties. So what we're doing a lot of right now are the fixed seconds. And that's what I kind of want to concentrate on today, because I know a lot of us are homeowners. Hopefully the majority of us are. If you're not, come see me and we'll talk to my friends. But we have ways of getting that equity now and fixing the equity. And the beauty of this for our self-employed folks out there, you don't necessarily have to show me tax returns. Because we know that you can afford it, we will use a bank statement product only. Basically what that means is we're going to qualify you based on your deposits that are going into your bank, whether it's business or personal. We don't care about what's going out. We're going to look at your deposits. We're going to average that over 12 months or 24 months, and that is going to be your income. Fixed seconds right now are in the 7s, the 8s. They were in the 10s, 10s to 12s, right? So we're already starting to see that adjustment because we're becoming very, very popular. We have them up to 90% of the value of your home on owner-occupied. Or we have them as low, not as low, I should say as high as 75% on investment properties. So right now I have a lot of clients contacting me going, John, I don't want to touch my investment property first, but I want to buy another property because I want to build my wealth. How much can I get out of the home? By the way, I W-2 myself at $400,000, but my corporation is negative 550, right? Because we have our write-offs. The solution is I go to them and go, well, Mr. Customer, I'm going to go ahead and give you a line for $250,000 on your $2.5 million property. I'm going to ask you for your bank statements. I'm not going to base it on prime because the Fed rate keeps going up, right? They're talking about increasing it again. So we're going to fix it, and we're going to fix it for a 20-year term or a 30-year term, and I'm going to give you anywhere between 7.5% and 8%. It takes about 15 to 20 days at the most to close the deal for these folks. Now they have the funds to either build their ADUs, to purchase another property, whatever it is that they need, and they have the confidence that that is fixed. You don't have to worry about the Feds coming out, Powell coming out, saying, hey, Fed rate's going up again, because every time on an equity line, when they make that announcement, you bet your bucket that your rate is going up, because equity lines are not fixed. The caveat, the difference between a home equity line and a fixed second is, I'm going to give you all the money up front. So that's really important for the client to know. It's not a line that you can say, hey, I only want to take $50,000 this month, and I'm only going to pay for $50,000. I'm going to give you a check for the entire amount, and you're going to start paying your interest on that entire amount the day it goes into your account. It's not a line that you can pay all the way down and then use again. Also very important, so once it's paid off, we go through the process again if they need additional funds. But it can be recast. So let's say it's $250,000, you're at a 7% interest rate, your payment's $1,500 a month. I'm just using those numbers. You take the entire line, you use, I don't know, 70% of the line, whatever it is that you use. If you give me a check for $30,000, or you give the servicer a check for $30,000, the loan now recasts. And now it's based on $220,000, not $250,000. Make sense? So your payment will automatically go down. So this is about positive cash flow too, because if these people have this payment, but they're using it to purchase another investment property, well, how much rent am I getting? What's my net? What's my cost here for the $250,000? What's my positive cash flow? Well, if we're paying down that 250 and we're recasting it every month, well, guess what? Our positive cash flow keeps going up, right? Hopefully. That's what we're trying to do. So, if you know anyone in that position that has equity in their house, everybody, and you want more positive cash flow, if you are looking at investment properties, or you just want to secure the equity because who knows what's going to happen down the road, we can do that. We can give you a fixed second. We can do an equity line too. You do have to show me everything under the sun for the equity line, and I'll tell you what, it's harder to qualify for an equity line than it is to qualify for a standard 30-year fixed cookie cutter loan. I'll tell you, it absolutely is, and I tell everybody that. I'll need your tax returns, I need your firstborn, I need your blood sample, I need a background check. No, it is, they have very strict debt to income ratios. And the debt to income ratio is a number people aren't, but a loan is. And if you go above a certain ratio, you do not qualify, right? There's no wiggle room there. On the fixed second, I've got a whole lot of wiggle room because it's a fixed second based on bank statements. So think about that. Talk to your people, have your people talk to me. Thank you for your time.
All right.